still not started investing into equity? You can raise your hands. Okay, one. Means have not started and never attended any session on financial literacy. Okay, wow, this is great because we have a lot of newcomers and we have a lot of established class, crorepati's and all, I should say. So it was like a very good thing that happened. Just for you all, it might be slightly of the basics, but you can ask any simple questions. So what I've done is, just in 15 to 20 minutes, I'll talk history. After that, I'll start mathematics. 2 subjects. Okay? Anyone who doesn't like history, especially Indian history? Okay, so I'll just start with this first. This is now with regards to finance only, but the history of this right from the time India was independent. Okay, because I find this thing very interesting because what happens is, as far as independence is concerned, in the beginning, our entire culture was totally different. We used to invest in 2 types of assets. One is physical assets and one is financial assets. Now this actually many people are not even aware of what is a financial asset and what is a physical asset. Because whenever we ask to prepare like a balance sheet, they look more into the physical assets. They don't look into their financial assets. Now physical assets comprises of your house, gold, cars, properties, all these things are called as physical assets. Whereas financial assets can be based into 2 types. One is where you lend the money to either an institution, like you can lend it to a bank, post office, PPF, insurance policies. These are all related to the interest rate, repo rate what we call it, and these are all related to market rates. So mutual funds and share market is totally market based, and bank, post office, PPF and insurance policies, most of them are related to the repo rate. Repo rate, I'm going to ask you one simple question after this. So you have understood these 2 things. These are the broad classifications of the ways people invest. They can invest either in physical assets or financial assets. Now, what we have seen in history of India, there are basically 4 phases in the things. Right from 1947 till today, India has been undergoing a lot of change. And I don't know how many of you are really proud to be Indians. Because in my case, I have traveled the whole world and I have seen each and every person all across the globe is jealous about India. Because India is the only fastest growing economy even during COVID times. Even now during Ukraine war times, still India is growing. The rest of the countries are going in recession. Whereas we are the ones who are only growing. And India is such a country which is so powerful, it's mainly because of its population. You have understood these 2 things? These are the broad classifications of the ways people invest. They can invest either in physical assets or financial assets. Now, what we have seen in history of India, there are basically 4 phases in the things. Right from 1947 till today, India has been undergoing a lot of change. And I don't know how many of you are really proud to be Indians. Because in my case, I have traveled the whole world and I have seen each and every person all across the globe is jealous about India. Because India is the only fastest growing economy even during COVID times. Even now during Ukraine war times, still India is growing. The rest of the countries are going in recession. Whereas we are the ones who are only growing. And India is such a country which is so powerful, it's mainly because of its population. Now what happens, these are the 4 phases which I have seen. First phase was from 1947 to 1991. Then 1991 to 2016, 2016 to 2020 was a very critical phase. And after 2020, what has happened to India? So I have taken each phase at a time. But before that, I just wanted to ask one simple question. Let's see who can tell me what is the actual definition of a repo rate and a reverse repo rate. Because every time now RBI, you can see on the newspapers, the RBI has increased the repo rate. Just 2 days back, RBI increased repo rate. Now what is the meaning of repo rate? Anybody? Yes, okay. Now the thing is what happens now, imagine if I am a bank, just name any bank, which bank you want. Say suppose I am HDFC Bank Margam, okay? And a client comes to me and he says I want a loan of 50 lakhs. The bank actually doesn't keep the money. The money is kept with RBI. So now what happens is, if you ask RBI to give 50 lakhs so that I can give to this client, the rate at which the RBI charges the bank is called as repo rate. So now I can borrow from the bank, from RBI, 50 lakhs and then give it to this client at 6.8% or 7%. So now whatever rate RBI gives me, the margin is my profit. Now if suppose by chance this client comes and gives 1 crore with me, I will take it and park it with RBI. RBI gives me a reverse repo rate for keeping money there. But the bank will not keep with itself. It will keep with RBI. RBI gives you reverse repo rate for keeping that money there. So whatever money I've kept with the RBI, it's basically like at a reverse repo rate, and whatever I borrow from RBI, I'm talking about as a bank. Now as a bank, I borrow it from there, it is repo rate, because I have to pay them for that much amount. So now what has happened is, because of inflation, now because of this Ukraine war, prices of petroleum and diesel, whatever, this is the oil, the crude oil prices have shot up to almost around 140 rupees per barrel, $140 per barrel. So the price has gone up, so automatically for the government it becomes more of an expenditure. So because of that, inflation has gone up. Inflation means the prices have gone up. Like food prices have increased by almost 14% in the last 1 month itself. If you check the way the food prices, like onions, rice, everything, the prices have gone up because of transportation. It's becoming expensive. So what government has done is, RBI has increased the repo rate so that the lending becomes less. So now what happens, if RBI is giving to the bank at 0.5% more, the bank will charge the people who are taking loans that much more. So because the loans have become more expensive, automatically businesses have started reducing their turnovers because of this inflation. So when businesses start reducing, automatically the markets start correcting. And that is what correction is going on at present in the last 1.5 to 2 weeks time. And slowly now what is happening is, as the market falls, the prices fall down. So as the prices fall, people start buying more. So this is now a correction phase which is going on as far as the stock market is concerned, but this is based upon the repo rate that the bank gives. Now immediately once inflation comes under control and petrol prices come back to normal after this war becomes, say, 1 or 2 months or so it might take, or it might even take 4 months, it might take even 6 months. Once the thing comes back to normal, automatically the interest rates again will fall down, and then the businesses will pick up again. And that is how it keeps on going in cycles. So repo rate and reverse repo rate is basically the way the bank and the RBI and the bank, they handle money with each other. So now, what was the situation in the post-independence from 1947 till 1991? At that time, the repo rate used to be 18%. The RBI used to borrow money actually from the public and give 18%, reverse repo rate was there actually of almost 18%. So at that time, PPF was offering 22%, that is before 1991, PPF used to give almost 22% interest, and fixed deposits we used to even get sometimes 24%. I don't know whether you're aware about it, but we used to get 24% on fixed deposits. That is in 1991 when I passed out dentistry. At that time I knew my grandmother used to always say, put in the bank FDs, your money doubles. That time it used to double in 5 years. Most of the fixed deposits used to double within 5 years. And then slowly, and that time what had happened is the income levels were very low because most were into agriculture and all this type of thing. And the below poverty line population was almost around 60% in India. And India was a real poor country. In such a way that the lifestyles, it's only some few people who used to make that much, but the Indian rupee was very cheap at that time. So poverty line was almost below 60%. Now comes the second phase in 1991. This is the time when the Congress government was there, and Indira Gandhi and all were the Prime Minister, Manmohan Singh was the Finance Minister. That is the time this one word was introduced, liberalization. Now what is liberalization? Liberalization was actually the time when foreign companies were allowed to start investing into India. Like Maruti combined with Suzuki, and you got Maruti Suzuki. But the only rule was foreign companies were not allowed to buy more than 49% of the stake of the Indian company. But foreign companies were allowed to buy the stake of this. And you won't imagine, so many foreign companies were eyeing India. So they came and merged with all the companies. Automatically the economy started growing. Jobs started increasing. So people started getting more jobs. So automatically India started changing as far as liberalization. But at that time, this physical assets, that is properties, gold, cars, Cars not that much, but mostly it is properties. Real estate was very cheap, and income tax collection was very low because people were not even declaring their income. It was like more of black income as compared to white income. In the sense they were not declaring. So this black money was accepted even in real estate and gold. So many people started buying gold, real estate, because that was like a good saving, because you could put in black money in that. So this is the time when more of real estate and gold was going on at this. Prices were really picking up because everybody was putting money into that, but all unaccounted money. So then after that, the third phase came, which was in 2008, and that also on the 8th of November. That date people will never forget. Fortunately, it's also my wife's birthday. On that night only, you won't imagine, suddenly that demonetization was done and the notes of 1,500 rupees were discontinued. And that was all the cash that was lying. And you won't imagine how much money came into the banks back. And all that money, people had to pay tax on top of it. So then the taxpayers started increasing. So automatically the number of taxpayers increased and money started turning into white, from black to white. So now what happens when this came, after that came this RERA. In 2018, this is after 2016, first was demonetization. 2018 was RERA, wherein all the builders, whoever is selling any properties, any building coming up, it has to go through legal documentation, and there was a clause put, any cash transactions above 10,000 rupees, you need to do it only by check. You cannot give any cash transaction, otherwise you can be taken to court. So now under RERA, each and every builder has to register first under RERA and then accordingly comply with the compliance, wherein every 3 months they have to submit their audit reports. Everything has to be given. So for builders, especially where a lot of black money was going, there was a scanner. So automatically the black money portion started reducing. So money started flowing more into the banks. So that is how more and more money started coming. And then in 2019, in August month, GST was imposed. This bill was passed and GST was imposed. Now what happens with GST? In GST you cannot hide, because the thing is, it's basically on your expense, it's not on your income. The one who spends pays more GST. It's like there's no classification like what you say, rich people pay less or anything of that sort. Everybody pays equal GST. But the only thing is, now if you are coming in an AC room, it is 18% GST. If you are eating in the restaurant which is without AC, it is 4% GST. So based on your luxury, automatically GST is charged. But finally, if you see, 80% of the items, whichever are consumables, GST will always be 0%. Whether it is medicines, whether it is food, whether it is agriculture, anything which is consumable will be 0%. What is highest GST 18% are things which remain in your house for more than 3 to 4 years, like electronic items, machines, mobiles, all the things which are luxury items are at 18%. Things which are there normally lasting for about say 6 months or 1 year, it is normally 4 to 12% GST. Like say for example, now if you buy any clothes, on clothes also there is GST sometimes. So now that this is there, but the GST will not be 18% like how it is for electronic items, because electronic items and all go up to 18%. But now what happens is, in GST, collection is from 100% population. And fortunately, if you have read even on the first of every month, if you read the newspapers, always it comes there, the monthly GST collection for this year compared to what it was last year. Like now the monthly GST collection for April 2022, can anyone guess what it was? As compared to April 2021. How much?
160 crores.
It is 1,60,000 crores. It is 1,60,000 crores which has been collected in this month, as compared to last year, which was somewhere around 90,000 crores. So there is a jump of almost 70,000 crores increase in the GST collection now. And this GST collection is totally white. You cannot pay by cash. It has to be done digitally, in the sense online. So you have to pay electronically, so all the records are maintained every second. So on the 31st of every month, the news is already declared on the RBI, on the GST website, and all that is published by all the newspapers. And this GST is again divided into two, that is the state GST and the central government GST. And you won't imagine Goa government, how much it is collecting per month today, can you guess? The GST collection of Goa state, small state of Goa, can you imagine what is the GST collection?
It is 24,000 crores. So you can imagine that much government is getting every month to spend for infrastructure, and all this is white money, not black money, because it is accounted. Now how it is utilized, that depends, but that money is official. What comes into it is official. How you utilize it, that depends on each government department, how they do the sale and all that thing. But allocation, even for the states, is much higher. And the biggest thing that has happened is now after lockdown, interest rates have started dropping down. And why these interest rates have started dropping down is so that people can take loans at a much lower rates. Like you can buy a car now at 7%, previously it was 12%. Just 2-3 years back, if I had to buy a car, I was paying 12% interest. Today I am paying 7%. If I was buying a home 2-3 years back, it used to be 12% interest. Today it is 6.7%. Wait for another 6 months, it will come down to 6%. But as the interest rate goes down, economy grows. Like now, because I'm getting a car at 7%, I can change my car every 3 years. Because the interest rate is much lower than what I'm paying income tax. So as the interest rate comes down, automatically spending increases. Lending becomes more. So when lending becomes more, economy grows higher. So this is how the interest rates have been going down, and this is the advantage why the economy has grown. So in the fourth phase of COVID, where actually it started in 2020 and the lockdown was imposed, that is the time when everybody started realizing why you need to keep money. Because before that, money was just flowing. But suddenly when the lockdown came, all businesses shut down, then they were wondering, where is that money going now? So the flow stopped. But fortunately, digital currency still continued. So all those who were actually investing and all started investing more, because now there's no spending. So when there's no spending, naturally you start investing, and everything is digital. So you can start investing, and that is how, when the stock market fell down by 40%, from 42,000 it came down to 25,000, you won't imagine, within 3 months it crossed almost 50,000. And people who invested during that time when the market fell are the ones who made the maximum profit. And now comes the basic questions which I want you to answer. The simple questions. If you answer these questions, your knowledge about financial literacy will be much higher. And these are very simple questions which are taught, which actually need to be taught for school children. I don't know whether you all know about it. First question is simple. What is the difference between wealthy and being rich? Can anyone tell me? Being wealthy and being rich. Yeah? Anyone can try. This guy is a wealthy person, that guy is a rich person. What is the difference? When can you say a person is rich and when you can say a person is wealthy? And what is the differentiating factor? There is only one word which differentiates both. Can anyone guess? Someone who is wealthy, someone who is rich. What is the difference? For this you need to have another word is this. Now let's see if you can tell about this. So wealthy and rich still you are not, but I will tell you now after explaining this. Now what is the difference between saving, trading, investing and insuring? Who can explain these 4 simple words? I save my money, I invest my money, I trade with my money and I insure my money. What is the difference between these 4 words? Are all the same? Who can explain this? Anybody can try. Because I'll tell you, if you know these 4 words, 90% of our seminar is done. You don't have to worry about the rest. Rest is all products. This is concepts. After that comes products. So what is the difference between saving, trading, investing and insurance? It's all related to money. So anybody can try any one word. Yeah, Joella? Because you have recently learned this, so at least revise it.
Saving is basically...
Better is that. Unless legs are paining.
Saving is basically just depositing your money and keeping it in the bank. Trading would be maybe like something related to the stocks, like you're buying and you're selling. Investing would be like as like something like mutual funds, or investing in something.
Okay. Anything else? Means any other way of explaining this? Because see, mutual funds, banks are basically products.
Yeah.
But I want to know the concept. Okay, if I ask you like what is the mindset of a trader, a saver and an investor? What is the difference between the 3?
Yeah. A saver is basically you're just putting your money in the bank and you're not really getting anything much in like return. Like whereas if you invest in mutual funds, like
Okay, and I'll tell you this same answer is given by 99% of people, and that is the reason why people actually don't grow rich. They feel that if I put in mutual funds, it is investment. If I keep in the bank, it is saving. It is totally wrong. 99% of people putting money into mutual funds are savers, they are not investors. 99% of Indians are savers. So much so I'll tell you, most of the savers, they live poor but they die rich. In the sense, they keep saving in mutual funds because the thing is like, okay, I can get better returns than the bank, so everybody looks at returns, but they save in mutual funds, they don't invest in mutual funds. So what is the difference between saving and investing? Mutual funds is just a product. Like bank is a product, PPF is a product, LIC is a product. But I'm talking about a concept, saving, investing, trading. What is the difference between the three? Because then you'll get the answer for the first question easily. Yeah, Dr. Laura can try. What is the difference between the three? Saving, trading, investing, and last is insurance. Insurance is also another part of it. Like what is saving versus investing? What is the difference? Yes? Okay, since we're not getting the answer, I think I'll only answer because of this. See, it's all on your mindset. Whenever you think of keeping money for the future, so that whenever you need it, you can use it, that is basically called saving. Saving is more for the rainy day. And let me tell you, even beggars save. So much so that today, you go to Mumbai, even the people selling, taking dabawalas, even they are saving in SIPs. All the dabawalas are doing SIPs of daily SIPs. So saving is basically when you think of keeping it for the future, so that whenever you need it, I will use it. So what happens? We only look at our saving part of it. Like now people are saving in mutual funds because returns are better, but only thing they're always worried about the markets. So they get scared about it. Why? Because they look at the profits. They look at profits going up, down, up, down, up, down. They keep on looking at that. So savers, they usually look at profits. Now, invest. Then I'll take you trading. Trading is basically buying, selling and booking profits. Without buying and selling, you cannot do trade. Like now say for example, we say we do intraday trading. Intraday trading or even other full day trading, or you can do even monthly trading. Whatever is trading, it's basically like dating. Dating, you get pleasure only for that night. Only when you sell, you will make profits. If you don't sell it, you don't make profits. You have to buy, sell. And most of the businesses are actually buying and selling and booking profits every day. The moment business stops, profit stops. So trading is basically like a daily buying and selling. So even if you go into shares, like now say cryptocurrencies, or you go into stocks, you buy certain stocks, like say for example, you buy of SBI today, you buy it at 500, sell it at 600, you book the profits and that is over. You are no more the owner of it. You just buy and sell. So that is called trading, which many people do. Like even in mutual funds also, we always try, we keep it for 2 years, shift it, put into another fund. From that fund, put into another one. And you keep on changing, looking at what others are doing. Like now say for example, if I'm putting into mutual funds, and say a person wants to invest 10,000 a month, he will put into 5 funds, 2,000 each, and look at it for 1 year or 2 years maximum. But after 2 years, he notices one is doing better than the other. It's like now you're having dating with 5 girlfriends or boyfriends, whatever you say. But now then you start comparing, and then when you start comparing, what happens? You keep on changing your partners every 2 to 3 years, and then you don't get results out of it, because that is basically what is trading. Whereas investing is what? Investing is being an owner of a company, or being an owner of shares, or being an owner of businesses. Like see, when I say I'm investing money, now say for example, any person is ready to start like a saloon, and we need to put in 40 lakhs of rupees for it. I'm ready to put in 20 lakhs, provided you pay me at least 20,000 per month. Now that 20 lakhs is an investment because I'm generating income out of it. Now same way, say suppose I start investing in shares, and by chance I decided I'm going to buy shares of SBI.
The moment I say I'm going to invest in SBI, it means I should get married to SBI for life. And in the period of say 10 years, I should accumulate at least 1 lakh shares. In good times and in bad times, in sickness and in health, I will be with SBI. And if I start accumulating the shares of SBI, especially when the market falls, I start looking at how many shares do I hold. Like investors always say, I own these many shares of this company. I own 40% of this company. They don't look at short-term returns. Short-term returns is for savers. Ownership is investors. Like now even in the mutual fund, if you are an investor, you will always say, I started investing in this mutual fund when the price was 10 rupees in 2014. Today the price has reached 50 rupees and I'm already owning 1 lakh units in this fund. And I have been investing in this fund in good times and in bad times. And bad times have done top-ups and I've got more units. So my average buying price is only about 20 rupees and today the price is 50 rupees. But I have 1 lakh units in that. So 1 lakh into 50 is 50 lakhs. And even if I leave it there, price goes up on its own with inflation. And for every rupee it goes up, you make 1 lakh rupees profit. Why? Because you're holding 1 lakh units or you're holding 1 lakh shares. But investing is basically owning. Now when you buy, sell, it is trading. And you just say for the rainy day, it is saving. Now, who is the one who becomes wealthy and who is the one who becomes rich? The one who saves money and has a lot of money is basically wealthy. But the one who is an investor and makes money even without working and gives it back to the society, those are the rich people. And you check, all rich people are people who have invested in stock market. And most of them are the ones who have businesses running. So their businesses is what is generating income for them. Like they are not working. Like Ratan Tata doesn't go in the factory every day. But the way he has established the entire businesses and now the amount he's making from there as a shareholder of it, automatically that money he wants to give it back to the society because he says, why do I need it? It's not, I'm not working for it. It is all my employees who are working for it. So that money should go back to the society. And these are people who have become rich. Like say for example Narayan Murthy, he also gives 90% of his wealth to the society. Why? He says, as long as I get my basic salary is enough, this money is coming from my investments. He has invested in Infosys from 1982. That time the price was 10 rupees. Today you can imagine how much he has made out of it. So where does the money go? It goes back to the society. So when you give, you become rich. When you keep, you become wealthy. Now who are the ones who are wealthy? Are basically the savers. And who are the ones who are rich? Are basically the investors. So if you invest your money, only then you can become rich. But if you save your money, you cannot become rich. You might become wealthy. You might even have 100 crores with you. But you'll still be protecting it. But when that 100 crores is generating for you, say around 10 crores per year, and that also without working, you will start giving it back to the society because you say, I don't require it. And finally you should know, you can't take it when you die with you. So you have to do what you can do for the society, then only you become rich. Otherwise you become wealthy. Wealthy is having lot of money, rich is giving lot of money. But the basic difference is, rich people are investors. Wealthy people are savers. They save in gold, they save in the house, they put everything in the house. They have a lot of money but there is no disposable income. Even though their salary might be 2 lakhs per month, but the day their salary stops, income stops. Whereas rich people make money while sleeping, not while working. Because they are investors, they are not savers. And what investors do? Most of the investors put it into the financial assets. Whereas most of the savers put into physical assets. I don't know whether you have seen it. Savers are the ones who build a very big home, have lot of gold, have lot of assets in the house but doesn't give income. Whereas people who are investors, they put most of the money into businesses and they live a simple life. I don't know whether you have seen the difference. See, business people, they put money into businesses because that is generating income. Whereas savers put money into the house, put money into gold, into physical assets which is not even generating 5 rupees income. And that is the reason why from saving you have to become an investor. Now how to become an investor rather than saving even in mutual funds is focus on owning units. Don't focus on short-term returns. Short-term returns is always there. Get married to one fund rather than dating with many funds. Like even in shares, get married to a company and go and attend the AGM meeting of that company and see what you feel as an owner.
The moment you become an owner of the company, that is the time when you feel the pride of owning it. But if you're just buying, selling, or just saving it, I'll give you an example. Recently we had one client, one doctor only. We suddenly found a share certificate of Abbott Industries, and the total number of shares, 10,060 shares. And this was like, now we found that certificate in the files, and you won't imagine what is the value of this. This was bought exactly in April 2002, when Abbott was launched at 10 rupees per share. And that time he got 10,060 shares. Like that he has got about 4 or 5 certificates. But you won't imagine, can you imagine what is the value of it today? Each share is 17,600. You multiply by 10,000 and see how much it is. It is 17.6 crores. Now can you imagine, he was not even aware that he has this. So now he is wealthy, but he is not rich. Why? Because he has not enjoyed life. Even though money is there, but not enjoying. Can you imagine with 17.6 crores, even if you generate 10%, it is 17.6 lakhs per month. And with 17.6 lakhs per month, how much can you do for your country? You keep your 17.6 crores, but imagine the amount that is coming from that. And if you start enjoying with it, only then you become rich. But if you keep saving, 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 you cannot do anything. And Goans typically, that's why I've written a book, most of the Goans, they live poor but they die rich. When they die, they leave huge inheritance, but they don't enjoy so much, so they'll bargain even for 5 rupees with the vegetable vendor. Even if you buy fruits, there also you'll bargain. Everywhere there's bargaining. Means what? You can't even see that that vegetable vendor is sitting on the roadside and fighting with that because of 10 rupees. But at home, huge deposits and a lot of money in mutual funds. How will you be called rich? But if you make a small difference to a person who is less fortunate than you, like now say for example I'm buying watermelon. This is the typical example which I've been giving there, because this had changed my life 5 years back. When I went to Ponda and I bought one watermelon, I just told him to give me the best one, whichever but I want a sweet one. So he selected one and took the weight and he said it's 4 kgs. So here the price is 20 rupees per kg. I took the watermelon, gave him 100 rupees, and I said keep 20 rupees as your consultation charges, because I also charge consultation fees. So this is your consult because you know which watermelon is good. So for that I'm giving you 20 rupees extra. And you won't imagine, I could actually see his face changing just because I gave him 20 rupees extra. And when I come to the car, he says, sir, I want to give you one, this is one papaya extra for you, keep it for your family. I said, but why? I am not paid for it. Because for the first time I have seen a person who has not bargained with me but instead given me extra. And this I have been doing now recently for the last almost around 4-5 years. And you won't imagine, the more I give, the more I get. And who becomes rich is the one who gives. Make a difference. It's not enough how much money you have. What makes a difference is what you give. And if you can make a difference to people's lives, automatically you start enjoying life much better. Because what I have noticed is, the difference between heaven and hell is basically when others pray for you, it is heaven. When you pray for yourself, it is hell. So if you want people to pray for you, you have to first make a difference to their lives. And for that you have to be rich. And to become rich, you have to be financially free. And to become financially free, you have to be an investor. You have to change yourself from a saver. So if you start investing, only then you can actually do. So now you have understood the difference between saving, trading and investing. And now the last word is insurance. What is exactly insurance? Can anyone tell me what is insurance and why is it important? And purposely I have kept it down below these 3 words. Why is it kept at the bottom and then the 3 words on top? Anybody? What is insurance?
It's used for emergency.
Insurance is for emergency. Yeah, what is insurance? What is the definition of insurance? No one knows. Insurance is such a common word. I'm not talking about life or general. Just the word insurance, the definition. What is the definition of the word called insurance? Yeah, can try. Either Clavina or what's your name? Vaishali. Yeah, can try the definition. What is insurance? Yeah, can stand. Better stand because there is. Yeah, what is insurance?
Is the way to manage your risk.
It is the means the way to manage your risk. There is one word missing in that.
Disability condition.
There is one word missing in that. Disability, risk are all secondary, but most important in that. What is insurance?
Compensation.
Compensation what? What compensation? That important word you are missing. Insurance is basically protecting from any financial risk. There is no other risk which you can insure. Like there can be risk of marriages breaking off. You can't insure it. There can be anything of like any other risk. If it doesn't involve money, you cannot insure. You can insure only loss of money. You cannot insure anything else other than financial risks. So wherever there is a financial risk, only there you can provide insurance. Like say for example in general insurance. What is general insurance? Like all health, then disabilities, then earthquakes, then fire, all these things. It will only compensate for the loss that you have undergone. It will not compensate for your business. It will only compensate for your financial loss. Now even if in case life is lost and that person was insured, it's only the financial loss which is replaced. The emotional loss cannot be replaced by insurance. Insurance takes care of only finances. And unfortunately, insurance is taken more as an investment, which is not an investment, it's actually a security. And why I've kept it down below is, you cannot do all these top things without having insurance. Insurance is one of the foundation for that building. Otherwise, you make a lot of money and by chance something happens, all your money can go down the drain in one day. Especially if you meet with an accident. So, or say suppose your house catches fire, or some earthquake happens, or there is cyclone and suddenly the roof only goes off. So all these things can be insured. So insurance is to protect from the financial risks. So unless and until there is a risk on finance, you cannot insure it. So insurance is to protect. So now what is more important? Wealth creation is important or wealth protection is important? What comes first?
Protection.
Protection always comes first, but incidentally, in our case, it is just the opposite. We want to make money first, and then we will think about insurance. Actually, insurance comes first and then comes growth. Because unless and until you are secured, you cannot actually grow your money plant. Your money plant has to be secured. So for that, insurance comes down, which is like a foundation, and then comes either you save, trade or invest. But if you don't have insurance, all your money can go down the drain. So you need to have, especially mediclaim is very important because health risk is the highest. The risk in life, the highest is health. Then second thing comes all the other things, like it can be like a accident risk, or even say for example the fire risk or earthquake risk, whatever the risks are there, they are all covered in this. But the most common is health risk and life risk. Now life insurance is basically to compensate for the income of the earning member. Like say suppose I have a machine now, so that machine is providing me 50,000 rupees every month. If suppose by chance that machine breaks down, if I have an insurance, I will still get compensated for it. And this machine is basically the human being who is actually the earning member. Like say for example the spouse or the husband, or it can be a wife, or the one who is earning. They have to be insured because their income has to be secured. Otherwise if you don't insure and suddenly something happens, the family goes into trouble. And if you don't have a mediclaim and someone lands up in hospital, especially now the senior citizens, like you have many parents who are at home. Imagine if your parents don't have an insurance cover and they suddenly land up in one of the 5-star hotels which are there in Margao. Because why I call them as 5-star is because I have experienced it. The daily bill of one room rent plus meals and all what they give is more expensive than what Leela is. In Leela we pay 16,000 per day. In Victor Hospital, you pay 28,000 to 30,000 rupees a day. So instead of staying in a 5-star in Kabilasim, you can stay in Marga also, you'll get everything ready. But the best part is, once you get entry, you become a member for life. Because you'll get one card. Because after that, it's like continuous. So every 3-4 months, you'll have to go there. And especially if you're a senior citizen, most of the diseases are recurrent. It's not a one-time. So what happens is, once you get that membership, if you don't have an insurance, all your savings, what you have done, because I've seen many elderly people, whatever savings they save for the last 30 years,
has gone down the drain only into medical treatment. And especially here, the 5-star hotels are terrific in Margam. You just go and try once and you'll see. The rates are terrific if you go, and that inflation is very high. So insurance is very much important if you want to secure your life. So saving, trading and investing you got. Now with this, can you answer now what is rich and what is wealthy? You've got the difference. So rich people are the investors, wealthy people are the savers. They keep on saving, but they don't spend. Whereas investors are the ones who spend because they are making money without working, because they are making money from their investments. Now comes another very important thing is because many people want to buy shares, like especially now when the LIC IPO was there. There is one more question with regards to that also, but first I'll just ask between this. Can anyone tell me what is the difference between investing in direct shares and mutual funds? Simple difference between investing in direct shares and investing through mutual funds. What is the difference?
Directly investing in the company.
Okay, and mutual funds?
Funds is many companies.
Yeah,
together.
many companies together, so the risk is less, but more important than that, what is the difference between investing in shares and investing in mutual funds? He has said about the risk, that is in mutual funds you're putting in more than say 30-40 companies, whereas in shares you can also put in 30-40 companies. It's not that you can't put it, you can put it. But the basic difference is not mentioned. What is the difference? Somebody else is managing, like even a broker can manage it. One very, very big difference, because the thing is you have to understand what is the difference in mutual fund and shares. Ownership is in both. You can own shares, you can own mutual funds also. But the basic difference.
Shares is a big amount.
Shares is a big amount, even mutual funds is a big amount. You can put any amount, even 100 crores in mutual funds. The basic difference is, in a mutual fund, there are certified financial analysts who analyze before putting your money there. If you can do that research, you can put in shares. But if you are not a certified financial analyst who knows to time the market and as well as put the money in there, in mutual fund you have professionals who work day in and out. They are, actually speaking, I'm telling you, they are much better than even doctors. I'll tell you why. Because if you go to any mutual fund office and sit with fund managers, one fund manager is there, that is on the top of each and every mutual fund, but under him there are minimum 7 to 8 certified financial analysts. I don't know if you have heard of CFA. CFP is Certified Financial Planner, that is like us, and CFA is Certified Financial Analyst, who study the stocks and have done a full-time course on it and know what is futures, options, even the buying of lots, everything. They've learned all these things, and these are professionals. Now these professionals are handling crores of rupees, not hundreds or thousand rupees. Like take any mutual fund. The minimum subscription price for a mutual fund to start is 500 crores. There cannot be any mutual fund with less than 500 crores. Otherwise the government closes that fund. So 500 crores is the basic. But most of them have reached to 25,000 crores or even 30,000 crores. Now imagine having 30,000 crores and you're giving it to professionals to work on it. So they research, like now even when LIC IPO came, they have done a research, and if you see who are the ones who have actually invested, are the ones who want to do gambling, like trading. And in the IPOs, the next this I'll tell you is how, but in mutual funds, there are professionals who are actually managing your money, and whenever they buy any stock, they analyze it before buying it because they put crores of rupees. They don't put 1,000 rupees. Like, see, if I lend my money to the bank, I'm actually putting it in the debt fund, that is the bank FDs. If I put it to the government, I put in PPF, I'm lending my money to the government and government is giving me interest. If I'm lending it to the corporates, I put it in bonds and they give me interest. So when I lend, I'm in debt. When I put myself in that business, there I'm in equity. In equity, I'm becoming an equal partner, so I'm not expecting him to give me any fixed rate of interest. I'm going to share my profits and losses with him. So I'm putting my money in a company where I'm going to share. So now what happens is, like now say if Dr. Laura and myself decide to put up a clinic. So now in that, I have not taken a loan, I have not lended her. It's that both of us have invested in it. So if it is a loss, it is a loss for both. If it is a profit, it's a profit for both. But suppose by chance she has taken a loan from the bank.
So the bank has lent the money to her, so she has to pay interest to that. Whereas for me, she is not paying any interest because I am in equity. Equity means I am becoming an owner of that company. Whereas if I lend to the company, I become a lender. When I lend, I put money into the debt funds. Debt funds are basically you're lending and getting interest out of it. Whereas equity funds, you're sharing the profits and losses of the company. So you have to understand in this. So now in a mutual fund, they can invest into the equity markets wherein they buy shares of the company, or they can lend the money in the form of debt, in the form of corporate bonds, or even give it to the government and take government securities from it. So debt funds basically put in government securities or in government bonds, corporate bonds, and these are the type of debt funds that we have. And equity is basically putting into businesses. So the thing is, like it's mentioned, non-guaranteed, subject to market risk. Now what is the meaning of subject to market risk? Is basically that you cannot take me to court if I give you last year 18% and this year 10%. Because it all depends on the markets. So let me tell you, you put into any business, if you are really successful in that business, risk is there, but most of the businesses give you profits of at least 10% margin. But the only problem is, we cannot say that every year you will get 10%. So it can be 20%, it can be 50%, it can be 100%, even 400%. But we don't look at that. We look only at what lowest we get. And sometimes it can go into crisis, like now during lockdown it was complete stop, so businesses had stopped down. It doesn't mean to say business are dead. So you have to invest in equity, and if you don't want to take risk, then there is a combination, what we call it as hybrid funds, what are balanced funds, is a combination of equity and debt. So on one side, they put certain amount where you get guaranteed returns, some side it goes into equity. So at the end of it, even if market goes down, your principal is maintained, and if market goes up, you get higher returns. So those are for people who don't want to take much risks. So usually when you put lump sums, you put in hybrid funds, which definitely give you higher returns as compared to debt funds. But equity is, if you remain in it, it's very easy to grow rich in this. Now this is a small thing, I wanted to check out whether you all know what is the definitions of all these. What is the meaning of a large cap fund, mid cap fund? Because you must have heard this, multi-cap, flexi-cap, focus, all these words I'm sure you must have heard. But do you know what is the definition of each one? Now what is large cap? This is in short, I just wanted to know what is large cap. So suppose you want to invest into a large cap fund, because now as per the new SEBI guidelines, each mutual fund can have only one fund per category. These are the categories of equity funds. So now if I am in Axis or SBI or Kotak or whichever mutual fund, there are 45 mutual fund companies in India. All the mutual fund companies will have one fund per category. So now it's basically that there are 45 cooks in the country, but they are preparing all this type of soups. There is large cap soup, mid cap soup, small caps, multi cap, flexi cap. These are all soups which are there. But now each soup has got different components. Now what is the meaning of large cap? Anybody? What is the meaning of large cap? What are components of large cap? At least from the word you should be able to say. Means putting a big cap. What is large cap? Yeah, what is large?
Large capital.
Large capital. What is large capital?
Maybe.
Market value. Okay, the market cap of any company is calculated how? The number of shares that are given into the share price. So which means that much money of the public is with the company. So the companies which the highest market cap, the top 100 are called as large caps, or what we call it as blue chip stocks. So blue chip means the top 100 companies. So if my fund is large cap, the names for the large cap can be either the top 100 like HDFC top 100, DSP top 100, or Axis blue chip. Blue chip means large cap. The names which are used are large cap, blue chip, or top 100. Means you cannot invest outside that basket of the top 100 companies. And all these companies are listed on the exchange. Now, from 101 till 150, those are called mid cap stocks. So if my fund name is mid cap, like HDFC mid cap, Axis mid cap, or any mid cap, like LIC mid cap, it means my stock composition is from that 150 stocks which are there in that basket. Maximum I can take 10% from large cap, 10% from small cap, but majority 80% has to be from mid cap. If my fund is small cap, I have a choice from 250 right up to 4,000. So the choice is much bigger and I can select any stocks from that basket. So small caps are the ones which have the highest number of stocks in it and the biggest volatility is usually in the small caps. Now, multi-cap is a combination of all three. It's like you put large, mid and small cap, but in multi-cap, you have to put compulsory 25% in large, 25% in small, 25% in mid-cap, and the rest of it you can put wherever you want, but mostly they keep it in cash. Whereas flexi-cap, there is no fixed asset allocation, and mostly they put 50% in large cap, 25% in small and mid-cap. But most of it is kept in large cap so that volatility is less. But in flexi cap, it's not a fixed asset allocation. Whereas in multi cap, it is a fixed proportion. It has to be 25%, 25%, 25 compulsory. So now, what is focused is you cannot have more than 30 stocks. This is like a mini PMS. PMS means portfolio management, wherein only 30 companies you can put in the portfolio. So before you select those 30, you have to study properly because you have to be focused. And these funds are the ones which take the highest beating whenever the market corrects. Like any focus fund, if you see, whenever the market falls, it falls the maximum. Whenever market goes up, it goes up highest. The volatility is more in this focus fund because the stocks are less and it is more focused, whereas these are diversified. So the risk is less. In flexi cap, multi cap, small cap, mid cap, large cap, you can even have 60 stocks in your portfolio. But in focus, you cannot have more than 30 stocks. So which means the risk is higher and returns also is higher whenever the market recovers. So if you want to be very aggressive, focused is the one where you can actually do, and you will be very much focused only in 30 stocks. Thematic is basically based upon a certain theme, like now say ESG, means there is an environmental company, which are ones which are dealing with environment, social activity and good governance, ESG. So there are different types of themes. And sectoral is basically one sector, like either pharma sector, infrastructure, IT, means only involving stocks of that company. Like now infrastructure, means only companies which are dealing in real estate, then say anything dealing with the construction of materials, like say Fevicol and all those things come under sectoral. So if you have a sectoral fund, you need to always time the market because each sector has a cycle which is approximately 8 years. What we have noticed, each cycle has got around 8 years. Now currently pharma was right on top. Now it will slowly start coming down. Infrastructure was down, now it will start going up. So you need to know when to exit, when to come out, means when to go in. So if you know that to time the market, then only you should go into sectoral funds. Otherwise you should never go into sectoral fund because there at certain stage it will go up and mostly people go into that when that is going up. Like now when pharma was, COVID started and pharma going up, immediately everybody started putting into pharma. So after that, now it will start going down. So slowly you should know when to exit, when to enter. So the sectoral funds are more risky. So if you know the timing of the market, then sectoral funds are good. But the best ones are these 5, wherein you don't have to worry about the timing of the market because it's all diversified. It has stocks from large cap, mid cap, small cap, and you are diversified. So your risk is much lesser. And the easiest one among all these, flexi cap, you just give it to the fund managers, they know how much to put in large, how much to put in small and how much to put in this because they have a flexibility. They can put how much they want. So you are giving it to the fund, whereas in these, it is limited. So the flexi cap funds are the ones which are the least volatile in the sense, even when market goes down, it doesn't get affected that much as compared to these. So if you want to play it safe, flexi cap is the one which you can play it safe. If you want to take high risk, focused is much better because you can take high risk, high return. If you are planning to keep it for a long time, means say for 5-6 years, focus will be better. But if you are looking only 1 year, 2 years horizon, flexi cap or even multi cap will be like a flavor for you. So you should understand what is the meaning of this type of funds. Anybody, any questions? No questions? Means everything is understood? Okay, so now I just want to ask one simple question. Is it difficult to grow rich in India? Is it difficult? No. So tell me how to grow rich. If suppose by chance I want to grow rich, what should I do with my money? So what is investing and what is trading? and what is saving. Now you know at least the difference between these three words. What is saving, investing and trading? You are getting scared to answer, but I'm sure you must have understood the thing. So what I want you to do is, from today onwards, start investing your money, start accumulating units, and say to it that I will accumulate at least this many units before so and so time. Like now, say for example in the mutual fund, I'll just give an example. Are you aware that the price increases and doubles every 4 to 5 years in a mutual fund? Are you aware about it? Like if you check any fund which is there before, say 5 years back, and today's NAV and 5 years back NAV, you won't imagine it gives you almost double the returns compared to if the price goes up by. And what I have done a study, I'll just share with you. Most of the funds, all the funds start at 10 rupees. Check the fund, by the time it reaches the 4th year, the NAV will be 20 rupees. By the time it reaches the 8th year, the NAV touches almost 40 rupees, not 50. 50 is mostly when it touches the 10th year. When the fund completes 10 years, on an average, the NAV becomes 50 rupees. But by the time it reaches the 12th year, the NAV touches 100 rupees. Now you can actually see power of compounding. And by the time it touches 15 years, the NAV is 200 rupees. By the time it reaches the 20th year, it is almost 400, between 300 to 400 rupees. And after it crosses 25th year, so just check which are the funds which have completed 25 years and check the NAVs of those funds. It will always be around 600 to 700 rupees now. And those which are doing very well, they have even touched 1,300 rupees. And they have crossed 1,000 rupees even at the end of 25 years. And there are many mutual funds which have started, because mutual fund actually started more in 1995. So in 1995 there were that time around 14 or 15 funds which were launched. All of them today, the NAV is more than 600 rupees. So you can imagine if you had to invest only 1 lakh and accumulate 10,000 units at 10 rupees. Today it is 6 crores. Minimum. So now what is the power of equity? It's basically the power of compounding. But what matters most is not how much or how many mutual funds you have. What matters more is how long you have been in it. And the longer you remain with the mutual fund, the bigger the profits come, because the NAV grows up on its own. But unfortunately, even SEBI has made a study, AMFI has made a study, and they have mentioned it, 90% of the investors don't remain with one fund for more than 3 years. And that's the reason why people don't grow rich in India. Why? Because they keep on changing the fund every 3 years. So much so that even financial advisors keep on doing it asset allocation, they'll say, and portfolio rebalancing. So what we do, we keep on changing the funds. And this was what I used to do even in before 2020. Keep on changing the funds every 2 to 3. It's like you're planting an apple tree in the front yard, putting the seeds there, waiting for it to grow for 2 years, and in 2 years you see only about 2 or 3 leaves growing only. And then you say the soil is not good, or the manure is not good, so I better uproot it from there. So I'll take it out from there and then put it in the backyard. Once I plant it in the backyard, again it takes 2 years for the roots to form. It's not growing only. I want apples, but apples are not coming only in it. So what I do from there, I'll take and put it again in some other place. Again over there it will take another 2-3 years for the roots to form. And unless and until you keep it there, water it for more than 5-6 years, that tree will not start growing up. Because in the first 5 years, it has to go below ground. In the sense the roots have to form and it has to get that stability. Once it gets that stability and it has got that grip, only then the height can come up. And check any fruit bearing plant. First 5 years, it will not grow more than this height. Why? Because it is growing underground. But the problem is we have to have patience. And if you don't take care of this fruit bearing plant, especially in the first 3 years, it can even be washed away by rains, it can go by the cyclone, you have to protect it first 3 years. And it's exactly like a baby. In the first year, it will only start crawling and sometimes it will even fall. Every time it falls, you need to give him something to eat and give him some strength. And this is like your mutual fund in the first year. There are many times that the market undergo correction, it goes in red. Do top-ups. Especially by the time it reaches the 3rd year, you will get red moments. Red moments is basically when the NAV is lower than what you bought yesterday.
Say suppose you bought it for 20 rupees and today the price has become 19 rupees, it will show in red, but your units will not change. It is only value which changes. Now if you get these red moments, it is basically a discount moment, which means you should buy more. Because when you buy more, and let me tell you, once you are with the fund for 5 years, you will never get red moments. So the best time is to buy in the first 5 years, and then you can just see it growing on its own. So if you can accumulate maximum units in the first 5 years, even if you stop, like I'll give you an example, there is one girl like Karishma, I'll tell you Karishma and Karina's story. One girl invests from the time she's 18 till 25, that is for 7 years, puts 50,000 per year. Total investment is 3,50,000, not more than that. And her sister Karina says, I want to enjoy college life and I'll start investing when I'm 25. She puts 50,000 per year from 25 right up till 40. So she is actually putting for 15 years, means 7.5 lakhs, whereas this one has put only 3.5 lakhs. But by the time they are 40, you won't imagine, Karina's 7.5 lakhs only becomes 10.5 lakhs. But Karishma's 3.5 lakhs already touches 21 lakhs. Why? Because she has remained in the market for longer period. So people who invest early are the ones who make more money as compared to the ones who start investing late. Start early so that you get more units and start saving now so that you can enjoy later. Otherwise, enjoy now and suffer later. Choice is yours. Habit. And the easiest way to grow rich is always pay yourself first and then pay others. Which means if I am getting 100 rupees, I take out 30 rupees first and then I spend 70 rupees. If I just follow this one rule, anybody can become rich in India. So I wish all of you all the best. I hope I have explained how easy it is to grow rich. Those who need personal guidance, who need any personal help, I am always there. There are no charges for it because this is now basically more of a mission for us to educate you all. Because for me it's like, even if I change the life of one individual in this world, it's like I'm changing the life of one family.